Right, a brief overview of what we're going to be doing today. We are going to be looking at the methods that is used to calculate GDP. And there are three methods that are used for calculation of GDP, which you would have been told about in grade 10. So now we are going to have a look at how this actually works, right? And the three methods are, so together they make up the word PI, so that it's easier to remember. So it is the production method, the I stands for income method, and the E, expenditure method. So in order to remember, because one of the popular exam questions would be list two methods of calculating GDP, or in a section A they could say which of the following is not a method to calculate GDP. Right, so your national accounts deal with the calculation or the recording of production. So we're looking at, when we talk about production, we think about the sectors of the economy. And by now you should be aware of what those three sectors are. They are the primary, secondary, and tertiary industries. And we will be taking a deeper look at this a bit later on in case you have forgotten what they are about. Secondly, we look at expenditure, that is the money that is spent by the participants in the economy, and the income that is generated. This refers to the revenue that is earned by the resources or factors of production, right? So we look at, first of all, the production, we look at expenditure, and we look at the income generated by the economy. They are an important means to measure economic growth, and the most important of these aggregates obviously being the gross domestic product, or otherwise known as the GDP. And by now you should understand the importance of GDP, and specifically the real GDP is used to measure economic growth. Right, so national income is the total value of all incomes earned by the citizens of the country. And when we refer to the citizens of the country, we look at the people inside as well as those that are outside of the country. As you are aware, we do have South Africans that are working in foreign countries, so their incomes would be added to the incomes of the people working within the borders of South Africa. Right, before we actually look at it, we're going to first of all look at terminology, and you should know that in economics, terminology is very important. It helps with our Section A questions, but furthermore, there are also some Section B questions where you're asked to define or describe a concept. Right, so when we look at, when dealing with national account aggregates, we're looking at the final goods as well as intermediate goods. Now your final goods, as the name says, these are goods that are ready for consumption by the participants in the economy. So the goods which we go into the stores to go and purchase, those are final goods. These are things that have already been manufactured, it's been through a process, and it's now ready for the consumer to make use of. Then we also have our intermediate goods, and these are goods that are used as inputs to produce other goods and services, right? So as you know, you don't just get the bread, doesn't just happen on its own, right? The bread the wheat has to be grown, which is then taken to have it mold into flour, and then it goes to the bakery where it's then an intermediate good or a resource for the actual bread that we go and buy in the stores. And when dealing with national account aggregates, we must be aware that we do not make the mistake of double counting. Now, double counting occurs when intermediate products are added to final products and will cause national accounts to reflect an incorrect total. So for the calculation of national income, we only look at once the good has reached the final stage. Any of those of you who do accounting will know the concept of work in progress. So any thing that is still being manufactured or in the process of being completed, that will not be added to our national income. Right, we also got GDP and GNP, and it is important that you know the difference between the two. So your gross domestic product, or GDP, refers to the total number of final products produced within the borders of the country, and in our case, obviously, everything that is produced within the South African borders or on South African soil, irrespective if it's a French company or an American company. The fact of the matter is that it's being produced within the borders of South Africa. So all of that would make up your GDP, whereas your GNP, as I said, is only the income earned by the citizens or permanent residents of the country, and we look at the people inside as well as outside of the country. So that means we've got to then, from our GDP, we will take away all those foreign businesses and foreigners working in South Africa. That will be subtracted, and then we will add all the monies earned if it's a South African company or South African citizens that are operating outside of the borders of South Africa. And that's the distinct difference between GDP and GNP. GDP refers to everything happen inside the country, whereas GNP, it refers to what is happening inside as well as what is happening outside, but only with regards to the citizens of the country or the permanent residents of the country. Then we also have a new term which you would not have heard about before. It's known as the residual item, and the purpose of your residual item is that it acts as a balancing item due to errors and omissions, and a bit later on we will see what that residual item or where that residual item is actually used. Right, we also have taxes on production as well. And please, you must not get confused between taxes on production and taxes on products, right? So your taxes on production refers to taxes on production not linked to a specific product, whereas your taxes on products are payable per unit of some good and service. And an example of a tax on product would be your VAT that is payable. There are other taxes on products, such as your import duties as well as your excise duties, otherwise also known as sin taxes. And then we also have subsidies on production, which are very similar to taxes on production. They are not linked to a specific good. And then we also have our subsidies on products. These are financial incentives to help struggling industries produce, right? So your subsidies on production, that is when government will help pay for any inputs into the production process, whereas your subsidies on products is where, for example, in Cape Town we have the Golden Arrow bus services, we have the My City bus services, and if we had to pay the full price of the ticket, the money that we are currently paying is a subsidized amount. So what happens is government will give Golden Arrow X amount. These are the number of tickets we sold for the month. So this is the total subsidy that we must get from you. And therefore, as consumers, we only pay a portion of the actual fee. Right, we now are going to look at the actual methods to calculate GDP. And as I said, the first one of the word pi is the letter P for production method, but you need to understand they also refer to this as the value added method, because remember, at each stage of the production, some value gets added to the item. So we start with the primary sector, and your primary sector deals specifically with the extraction of raw materials, right? So businesses, you've got to know or give examples of businesses that operate within the primary sector, such as fishing, farming, etc. So anything where we're dealing with the extraction of raw materials. The secondary sector, this is when those raw materials are transformed into final goods and services. And one of the sectors that students many times forget is that electricity is actually manufactured, right? We don't just get electricity, right? They use the coal or whatever ways in which they manufacture that electricity, which then is sent to our homes. Tertiary sector, this is the sector that is responsible for distributing the final goods and services. So all of your services belong in the tertiary sector. Services such as hairdressing, plumbing, a doctor, lawyer, teaching, etc. As well as your delivery people, right? They will form part of your tertiary sector. So your production method, we're looking at the primary sector, secondary sector, and the tertiary sector. When it comes to the income method, so as we said, we're looking at the income earned within the economy. So here, this method looks at the contributions made by the various factors of production. And the first one here speaks about compensation, and that is our keyword, compensation paid to employees. In layman's terms, this is known as salaries and wages, and you should now immediately think which factor of production earns salaries and wages. Which factor of production has the reward of salaries and wages? And by now, you should know that that is labor we're referring to. The next one is the net operating surplus, better known as net profit after tax, and the keyword here is surplus. Right? In accounting, we speak about net profit after tax. In economics, we talk about a net operating surplus. And there your factor of production is obviously entrepreneurship. And then the third one, which is the consumption of fixed capital. And the keyword here is the fixed assets. Now, if you think of the word consumption, is the same like using of fixed capital. And the accounting term for this is depreciation. Now, for those economics learners who do not do accounting, you can hear from the name of the term depreciation. So if something is depreciating, it means the value of that asset is decreasing. For example, take a motor car. You buy a car, 300,000 Rand. Right? As soon as you drive that car off the showroom floor, you've already lost 20,000 Rand. So once you get home, the car's only now worth 280,000 Rand. So therefore, we've got to make allowances for the consumption of fixed capital so that we don't get an inflated figure of what the value of the asset is. So with the income method, we've got the compensation paid to employees, net operating surplus, and the consumption of fixed capital. And then the last method, which is the letter E, which is for expenditure method, this method looks at the amount spent by each of the participants within the circular flow. Now remember, I said to you, this section of work is linked to the circular flow which you did in grade 10. And there we have, you should have been taught already that when we talk about consumer expenditure, that will be denoted by the letter C, whereas your government expenditure will be denoted by a letter G, and investment expenditure, which refers to the money spent by businesses, that will be denoted by the letter I. And you were taught in grade 10, C plus G plus I plus open brackets X minus M close brackets is your GDP. So we're still using that method. I put the letter Z in brackets here because I know some people still use the Focus textbook and they speak about the letter Z for imports, right? But please bear in mind the letter M is the globally accepted term for imports. Okay, so here it says this is like the GDP formula that you were taught in grade 10. So now we are going to take a look at the actual calculation or the formulae that is used within each of these methods, right? So the first one, your production method, and you need to learn this formula. You actually got to be able to close your eyes and write it out without having to look, okay? So when we're dealing with the production method, we're dealing with the three sectors of the economy, which is primary, secondary, and tertiary. So we add, and this is also, like I said, known as the value added method. So you add those three totals together, and together these three will now give you your GDP at basic price. But what you need to remember, this could also sometimes in a test or exam, they could give you GVA at basic price, but then GVA actually just stands for gross value added, okay? But it's the same meaning as GDP at basic price. And then if you're converting your GDP at basic price to GDP at market price, you have to add your tax on products and minus subsidies on products, right? So GDP at basic price plus tax on products minus subsidy on products gives you your GDP at market price. So I just want you for a second to just look at that, close your eyes and make sure you can sort of see that in your mind's eye, that it's primary, secondary, tertiary added together gives me GDP at basic prices. And then to convert my GDP at basic price to GDP at market price, I have to add my tax on products minus the subsidies on products. Now, to just take this a little bit further, besides knowing the layout as it is here, you also have to understand what is meant by the term GDP at basic price. What is meant by the term GDP at market price? So if you look at it, here is the extraction of the raw material, here is the processing of that raw material, and here we have the finished product. So this actually represents, or your basic price actually represents your cost of production, what it's costing you to produce that particular good or service. And then you take your cost price and then you add your taxes minus your subsidies, which will then give you the market price, which is the price that the consumer is going to pay. So here, basic prices represents cost price, whereas your market price, on the other hand, represents the selling price of the item. Okay? So another, or the way in which you can explain what is meant by GDP at basic price, that is the cost of production, or what it costs to produce the item, and your GDP at market price is the price that the consumer is going to pay for the product, so that would then constitute your selling price of the item. Right, the income method, on the other hand, here we're looking at the factors of production. So you would note here, you have GDP at basic price, GDP at market price, which is exactly the same as you have it with the production method. And please note that when you're converting your GDP at basic price to GDP at market price, you see there plus tax on products, minus subsidies on products. We go to the income method to convert GDP at basic price to GDP at market price, exactly the same. Taxes on products, subsidies on products. It's no different, okay? The difference with this now lies that here we've added a GDP at factor cost, which we didn't have with the production method. So your income method is your compensation paid to employees plus the surplus plus the consumption of fixed capital, which will now give us our GDP at factor costs. And then if I want to convert my GDP at factor costs to the GDP at basic prices, I now add taxes on production minus subsidies on production. Now please note, when students are asked to do this calculation, they always get confused between these two and they swap them around. Remember, you have to, before it becomes a final good, it has to be processed first. So the production comes before product, okay? Product is the final, production is when it's still being made, okay? So very quickly once again now, we pause for a moment and we look at this particular method that says it is the compensation paid to employees plus net surplus plus consumption of fixed capital, right? It's going to get a time to get used to that terminology, but you need to just learn it, okay? And you need to understand the compensation paid to employees is your salaries and wages, your surplus is your profit, and the consumption of fixed capital is the depreciation or what it's costing you to use that particular machinery or vehicle. So your GDP at factor cost, that represents what it's going to cost the business to employ or use the factors of production, right? And then, as we said previously, your basic price is your cost price, your market price is your selling price. And to convert GDP at factor cost to GDP at, that is a question that you will be asked. How do we convert GDP at factor cost to GDP at basic price? So we go GDP at factor cost plus taxes on production minus subsidies on production equals GDP at basic prices. And to convert my GDP at basic price to GDP at market price, I add taxes on products minus subsidies on products. Okay, before moving on to the final method, which is the expenditure method, I just want to pause here and look at how do we convert GDP to GNP. Now remember, GDP stands for gross domestic product and GNP is your gross national product. If you remember from our list of terminology, we said the GDP is about what happens inside the country. GNP is only the citizens or residents of the country. So to convert GDP to GNP, we take our GDP at market price and we add primary income from the rest of the world. Now, what do we mean by primary income from the rest of the world? If I am a teacher teaching in England or America or Dubai or wherever, then that is my first source of income, so that's my primary income. So then we have to add all those South Africans working overseas and earning their income from a different country other than South Africa. That would then be the primary income from the rest of the world. And then all those foreigners working in South Africa and making a living in South Africa and those foreign businesses operating in South Africa. So we will then deduct all the primary income to the rest of the world. And that then becomes your GNP at market price. Okay. The problem with national figures, they're not always accurate because there will be some problems. And like I said, one of the biggest problems is obviously the double counting, where things are counted more than once. There are products that could have been excluded. Mistakes happen. Accuracy, people do make mistakes. If I'm writing down the number and you shouting at the number, I'm hearing one number and you saying another number. And obviously we have to make a distinction between nominal versus real income. Now, just so that you still understand what is the difference between nominal and real, in economics, when we speak about nominal, it is the raw figures. When we speak about real, that is when those figures have been adjusted to make allowances for inflation, etc. Right, when we come to your expenditure method, you would note here that there is no GDP at basic price. If we just step back for one moment, you see there with the income method, we had GDP at basic price, GDP at market price. We go to the production method, GDP at basic price, GDP at market price. Yet, when we look at the expenditure method, we only see a final year of GDP at market price. Why? Why is this method different from the other two? Reason. When you're looking from a production method perspective, you are looking at when the product is made, right? You're looking at the sectors of the economy. So you're looking at the making of the product. The same with the income method. You're looking at what you're spending on the factors of production. You're looking at what is it costing you to make this product. Whereas in the expenditure method, you are looking from an expenditure perspective. So I just want to, before we go and look at that method, I just need to explain this to you. So let's say, for example, we have produced 10,000 units. You're not necessarily going to sell all of those units. So if you're working from an expenditure method, then you are only going to record those things which have been sold. So let's say we sell it for R1 each. So remember, my GDP at market price must be the same whether it's production method, income method, or expenditure method. So let's say we produce these 10,000 units and we're selling them for R1 each. So under the production method, I would have my 10,000 Rand, because that's how much has been produced. Under income method, it's also going to give me 10,000 because that's what's been produced. But under expenditure method, if we only sold 9,000 units, we're going to get an answer of 9,000 Rand. We are short of 1,000 Rand because what has happened? We produced 10,000 units, but we only sold 9,000 thereof. Okay? And this is where that residual item, remember I said to you it's a balancing figure, so that's where the residual item comes in. So to ensure that the expenditure method balances with the other two methods, we will then add that 1,000 Rand as a residual item so that the final figure will still be 10,000 Rand. However, it is also possible that you only produce 10,000, so you can only receive 10,000 Rand. You can't physically sell more than what has been made. But it does happen where at times you produce 10,000 but you made 12,000. So where did the other 2,000 come from? So now we have to subtract that 2,000 to ensure our final figure is also 10,000. So therefore, if you look at the expenditure method, you would see here, I said plus or minus for the residual item. Okay, so it depends on what has happened. Obviously, if it's a plus, then everything's fine, because all it means then is that we didn't sell everything that was produced. But if it's a negative, it means we sold more than what has been produced in the country. So what that then says to be, some goods have made their way into the country illegally, or somewhere somebody didn't add something correctly and now I'm sitting with these. That is why in your terminology it says residual item is a balancing figure for any errors or omissions that have taken place, right? And within your expenditure method, you're looking at what is being spent by the participants, which is your consumer, your government, and your business, right? Investment expenditure refers to the money spent by businesses. And then you will get your gross total. So all of these plus or minus the residual item will give you your gross domestic expenditure. Then we add our exports and we subtract our imports, and that will give us our GDP at market price. And just before this, I asked you, how do we convert the GDP at market price to GNP? So if I wanted to convert that to GNP, I must add the primary income from the rest of the world minus the primary income to the rest of the world. Right, let's look at the first activity for today's lesson. 1.1 says, briefly explain the following concepts. It says briefly. Now please look at your mark allocation. GDP at basic price, it is only for 1 mark. So you can just write a word or two. The same for GDP at market price. Whereas if you look at the third one, where they ask you explain GDP at factor cost, there it is 2 marks, then you need to give us a full sentence. Okay? So if it's a 2-mark answer, then you please need to give a full sentence. So, right. GDP at basic price, GDP at market price, GDP at factor cost. I'm going to give you 1 minute to just think about that quickly. Right, then we move on to the next question, which is 1.2. 1.2 asks, what is the purpose of subsidies on products and subsidies on production? In other words, why do we have subsidies on products and why do we have subsidies on production? And somebody gave me an answer which was like, I didn't even think of it, but I will share that with you shortly. 1.3 asks, how do we convert GDP to GNP? And 1.4 says, list an example of a tax on product and a tax on production. Right, we're going to have a look at these answers and just make sure if you had thought about the correct answers. Right, number 1, if you just said cost of production or cost price, that would give you 1 mark. If you just said price paid by consumers or selling price, that's another mark. But when it comes to the question on the GDP at factor cost, you've got to give me a full sentence, right? So you've got to say your GDP at factor cost shows the cost of employing the factors of production to get the full 2 marks there. Right, subsidies on products. These make goods or services more affordable for consumers, whereas subsidies on production allows producers to increase production levels. And it's here where a learner said to me, so actually what you're referring to are consumer subsidies and producer subsidies, which is another way to look at it, okay? And then the last question was, how do you convert GDP to GNP? And there we've got the GDP at market price plus primary income from the rest of the world minus primary income to the rest of the world. That is equal to our GNP at market price. Right, before we move on to the next one, I just want to have a quick look at the layouts very quickly, right? For production method, we're dealing with the sectors of the economy. With the income method, we're looking at the factors of production. And with the expenditure method, we are dealing with what is being spent by the participants within the economy. Because the next activity 2 deals with the actual calculations now. That's why I just needed to go back. Right, so look at activity 2 here. It says, study the information below and answer the questions that follow. So the information that they give us says GDP according to economic activity, and these totals are in rand millions. So they say to us there, it is the primary sector, secondary sector, tertiary sector, taxes on products and subsidies on products. That's all the information which is given to us. Then we have 3 questions that we need to answer. And obviously the first question is, which method is used to calculate GDP? Now you've got to think back, what is it that I said? The 3 methods, each method is known for something or other. So here we're dealing with the primary sector, secondary sector, tertiary sector, which I remember learning in grade 10. These are the sectors of the economy. So if it's the sectors of the economy, then obviously that has to then be the production method that we are looking at here. Right, Then they ask us to calculate GDP at basic price and show all calculations. And then what learners do is they write out a nice sum for you with all the numbers. But if you look at the next question, 2.1.3 asks, convert GDP at basic price to GDP at market price. And once again, they say to you, show all calculations. And if you're just writing a whole lot of numbers, it makes the marking a bit difficult, especially if you're marking 50 scripts from one class. And so therefore, rather set out your answer in the way that you've been taught, right? You set out your answer according to the formula that you have been given. So if you look at my memo here, you would see there, yeah, we already know that that answer was the production method, but 2.1.2 asks you to calculate GDP at basic price, whereas 2.1.3 asks you to calculate GDP at market price. So by writing out the actual layout, you actually can't go wrong, right? So what we've done is we've taken the primary sector, added the secondary sector plus the tertiary sector. So these three totals here together gave me the 3314978, which is my GDP at basic price, and that is the answer for 2.1.2. Then 2.1.3 asked me to convert the basic price to a market price, and I know our formula is plus taxes on products minus subsidies on products. So I take my 3314978 plus 309486 minus 17558, and that gave me the answer of 3606906. Right? So there you've got the entire production method given to you. Now, in the same way, you could be asked, this question could be set up, but now instead of having primary, secondary, tertiary, you could have here compensation paid to employees, net surplus, consumption of fixed capital, taxes on products, subsidies on products, taxes on production, subsidies on production. Then you know you're dealing with the income method. Exactly the same questions can be asked, but just the method would differ, and obviously then the layout of how you show your answer would also differ. I just need you to look at that very quickly so that it can sink in and you see how you structure your answer. Right, then just to recap what we've done today, we've looked at the three ways in which GDP is calculated, and I said to you at the very beginning, you need to remember the word PIE, pi, and that is your production method, where we look at the sectors of the economy. The income method, we look from the factors of production perspective, and the expenditure method, where we look at the amount of money being spent by the different participants within the economy, right? And that is the same as the method that you were taught to calculate GDP in grade 10, which said C plus G plus I plus X minus M. The only difference now is that you have another item, which is your residual item. Now, just to hone in on that residual item once again, because this is something that is very tricky and does, where learners do slip up. So you've got your C plus G plus I plus X minus M, but this year is your balancing figure. Reason why we need this balancing figure, because in the expenditure method, we're looking from a selling perspective, right? From what is being sold in the market. Whereas if you look at your income method or your production method, you're looking from the cost perspective. So in order to balance the GDP at market price according to the expenditure method, and to make sure it measures up or is equal to the GDP at market prices for our income method and our production method, we have the residual item that makes up. And as I said, that could be a positive or a negative. You also need to understand, or one of the questions you could be asked is, what does it mean if your residual item is negative? That means I had to take away something. So that means that there was more stuff sold inside the country than what actually was produced within the country. Various reasons why that can happen, but that then needs to be investigated, right? Whereas if it's added, if it's a positive figure, then that simply means that we haven't sold everything that was produced within the country. Right, and then the other important thing obviously is this question here, the conversion of GDP to GNP. Oh, I think we forgot this last one here, 1.4, the example of a tax on product and a tax on production, right? For a tax on products, I said there are three that you could mention. We have VAT, we have import duties, and we have sin taxes or excise duties. Whereas your tax on production, there we have what we refer to as payroll taxes. And if you do stuff like business studies or accounting, you would have heard about the skills development levy. So the skills levy is a payroll tax. So that would be an example of a tax on production. Or any monies paid on land and buildings would also be a tax on production. Right, the conversion from GDP at market price to GNP at market price, very popular question there as well. And then the other one that's also popular is obviously showing how to calculate your GDP at basic price and how to convert the GDP at basic price to a GDP at market price. And grade 11s, I thank you for your attention. That's all you need to know at this stage about national account aggregates. Thank you.